Hello, hello, and happy Tuesday, everyone. It's an absolute pleasure to welcome you to today's webinar here that Swisspreneur is hosting together with Holy Code. And we have three fantastic guests joining us here today. I'm going to introduce them with the first questions to every single one of them. Kai, we're going to start with you as the first guest. You've been running Oviva, a company digitizing medical nutrition therapy since 2014. So that's 1 decade of running a scale up, basically. And I just wondered, what have been the biggest and perhaps also the most painful lessons that you have learned and gone through so far?
Sure. And thank you for having me. It's a pleasure to be here. So I think the biggest learn for me so far is really that how much time and resilience it takes. A decade is quite a long time, but I've come to the understanding that I think most big successes do need kind of that whole decade and running your head against the wall again and again and again, many times over that decade.
It's sort of part of the entrepreneurial game in that sense. Thank you for being here and for your time. We're going to dive into a very interesting topic shortly. Our second guest is Frederick. You're the CFO at Anybotics, also a really fascinating Swiss scale-up company. But before you joined them in 2018, you actually worked for M&A advisory firms. And I just wondered, why do you trade the stable and potentially high income from investment banking for the startup world?
Yeah, so not sure about the stable, but probably yes on the high income. So for me, it was the stars kind of aligned. I was advising companies for more than 5 years, and I always knew that I wanted to build something as well. So for me, it was kind of the perfect opportunity to do something really deep tech. I didn't want to join kind of a business school startup, but build something with a significant tech background, virtually from the ground up. So it was also then a special relationship that brought me here. Peter, who's one of the co-founders and our CEO, and I, we know each other since high school. So had a trusted relationship. I was already kind of on the sidelines before Anybotics was founded. And then after 5 years of M&A advisory, before having kids, being able to take a pay cut, etc., I knew that it was now or never to take that leap of faith.
Amazing. Super exciting. Also, thank you for being here today.
It is a pleasure.
And last but not least, Laurent, here you are again. Welcome back to the webinar series. Recently, LinkedIn has chosen you as a top voice for entrepreneurship. And you got one of these fancy badges in your profile now. Have you been using your newly gained powers for good so far?
I'm not sure that there's any, powers that come with it. So, sorry, my microphone just switched off. I don't know if there's any. I don't know if there's any, new powers that come with it. To be honest, I don't see anything in the impressions or the amounts of likes or anything like that on LinkedIn. But yeah, it's just cool to have such a badge, obviously, and I think it's a nice recognition. But yeah, other than that, I don't really give too much about these sort of badges.
Fair enough. You have enough other stuff on your plate, luckily. Also, thank you for being with us again today. So guys, we have a topic focus for this webinar. It's about how much should I raise in a Series A or B? And I'm going to start with you, Kai. Let's say we went to product market fit. We have a sales team. We have a product that is scaling, but now we also need some money. So what is the range of funds that scale-up teams typically raise in a Series A? I think you have a few cents to add to this with your own experience.
Sure. And I think it's just very important to step back, kind of reflect on what does a Series A really mean for a second. And what it principally means is it's a class A of shares that go on top of the common shares, right? The same for the B and the C and so forth, right? And what that means is you often have preference shares that go on top of the common shares, what the founders and initial team would have. Maybe angels also have. And in that class A of shares, you bring on new investors, and typically they come with additional rights, right? So there's things like liquidation preferences, which is kind of a more standard term, and there's many other different terms that you can put on top of it. But it's a separate share class that comes across on top that has different control rights. And the range of funds can vary immensely, right? You can do a Series A after bootstrapping for a decade or two. There is then kind of the standard startup journey that's kind of evolved and emerged, where there's kind of the standard Series A, which also has wide ranges of 5 to maybe 20 million, I guess, is kind of the range that one could say now. There's also what you also have to differentiate a little bit is what people put into the media, which is often it's aggregate rounds and somehow they call it a Series A. But I think the first interpretation is really important. It's kind of a class A of shares that come on top that you raise a significant amount of funds with to kind of take that next step.
And I like that because that's super important when you eventually make it to an exit. These shares usually get paid back or paid out first, right? That's a very important part to keep in mind for founders.
Yeah, I mean the range of different terms that are attached to them are incredibly varied. But if you look at kind of the most standard terms, the first one that usually comes into it is a 1x non-preferential liquidation preference. Non-participating liquidation preference. And what that just means is that they get their money back initially, and then the proceeds are then distributed again based on the shareholdings. But there's so many other terms that one should be familiar with before one goes into that. It's good to read the standard publications about that.
Amazing. Frederick, when it comes to raising a Series A or also Series B, you always want to get some money in your company to extend your runway and to be able to finance your operations and additional investments. How much runway should we aim for? Usually in the early stages, you say 12, maybe 24 months. Is that the same? Is it more? Is it less for Series A or Series B?
Well, as Kai also said, I think it really depends on the company. So I think what I always also talk to other founders about is before assessing your runway for a specific round, you kind of need to take a step back and really understand what's the dynamic of your company. How much cash will the company ultimately need to become profitable? Is it a pretty light company? Is it just one round and then you're through? Is it deep tech, for example, like Anybotics, and you'll need several rounds? That really changes the dynamic of that question, because either it's kind of a pretty we need one round and 1 year or 3 years or 4 years and then we're through, and the dynamics of the fundraising won't fundamentally change. Or you understand, for example, Series A, you're still pre-product market fit if you're tough on the term product market fit in deep tech often, right? So then you really need to be very, very conscious around the milestones that you need to achieve until you go out funding for the next time. So step one, assessing, what is ultimately the funding need that I believe I have today for the company in the long term, and then break it down into rounds and milestones that you need to achieve. So typically when you then think about those milestones and the inflection points down the road, it is, as you say, typically 12 to 24 months. Why is it 12 to 24 months? Because below 12 months, the risk of not achieving something and having a very short breath is just too high. Above 24 months, it is often then a question, hey, why do you raise so much today at a lower valuation if you will reach inflection points in the next 24 months to then raise at a higher valuation, have less dilution? So it's typically, I would say, the 12 to 24 months plus a certain buffer, right, to make sure that you actually can reach that inflection point, because reaching then the next inflection points, having your company at a next stage, makes fundraising massively easier in subsequent rounds compared to just having to tell the same story with an only slightly different twist over again.
And exactly, and there's a delay or something, then you have a bit of your back to the wall. I have a follow-up question about the buffer that you just mentioned. Often you come up with a very detailed budget and say, this is what we're going to do with the money. These are the milestones that we try to achieve in these 12 to 24 months. And then there's this buffer. How big should this buffer be? Do you just add it as a percentage on top of your budget, or how does that work? Because sometimes I feel that can be difficult to explain to the investors what you want to add this buffer for in the budget.
Yeah, so I would less think of it as a buffer in cash. I would think of it more as a buffer in time between inflection point, materializing, and start of the next fundraise. So it's not just, okay, and I want to raise 5 million on top of that. That doesn't fly. You're right. It's rather, look, I believe, in summer next year, we have a fundamental inflection point of the company, and that's in nine months from now. However, I want to make sure that I don't need to go fundraising next year already, just to make sure that we can either capitalize on that next inflection point or have a buffer if that inflection point comes later, that I only need to go fundraising again, let's say in Q1 or Q2 2026. I would think of it a bit more like that. And then there's also the market perspective. Ultimately, it's not only in your hands how much buffer and how much runway you can create, right? It's ultimately also the excitement around your deal, and that also informs kind of your runway and your burn then ultimately.
But I like that. It's more about extending the runway a little bit than just a percentage on top of it. Fantastic.
Definitely.
And I agree with that point.
Yeah, sorry.
There's a huge amount of signaling value in terms of what you look for when you fundraise, right? Because that's always one of the things is what is your key ask? And what that typically signals is, people assume that with each round you take 20-ish% of dilution, right? It can range, again, those things vary quite a lot. But when you come out and say you're looking for 10 million, that means they'll assume you're looking to do that at a 50 million-ish post-money valuation, and they'll do that math backwards in terms of before they ever start discussing an actual valuation with you. So you're doing a lot of signaling with your ask already in terms of what the valuation will be. And it's important to think about that too. And then once you've reached where you have term sheets, then the dynamic completely changes, right? So at that point, you can then start discussing very different plans again. Once you have enough interest for the deal, because once it's funded, people are also usually very happy to overfund a deal. There's then the question of how much dilution you want to take.
Fair. Really good points. Thank you for adding those, Kai. Laurent, over to you. When it comes to really looking for these investors, usually you already have some investors from your pre-seed or seed round if you raised money before. Then the question is sort of, should you try to get the same investors on board with higher tickets? I know that's not always possible. Or should you always also start looking for new investors? What sort of the best mix that you see in the market there? Is it a mix of both? Is it just bringing new investors on board? What is your take there?
Well, if you can get your current investors to invest again, obviously that's very good signaling again. Also, as Kai said, because it shows to any other investors that the guys that have more insight into what your company is doing still believe that this company has growth ahead. But realistically, a lot of the first investors will not have, as you also mentioned, the cash in their pocket to go and fund this next bigger round. And I also think it's not good to only have those, because what you want to do is you want to start growing your investors pool, not extensively, but with certain people that are, or certain funds that are actually really well known on the market for that kind of investments, and can also help you then fund the next round after that if you need one, either themselves or by having very good relationships to those next investors, because they've been doing deals together on and on and on, which then reduces the stress a little bit on you as a founder to go out and find all of those next round investors. So I think it should be a mix. It should be signaling from the old investors that they're willing to participate again, but you should always bring in one or two big ones that really have that kind of professionalism, that expertise in this new stage of your company, that can take you to the next round, because you also always have to think of the next round after that, right? So you should also have that in mind and be prepared to onboard the right investors.
It never stops. Let's look at the real example with Oviva, Kai. Is that exactly how you did it? A mix of new and existing investors participating as well?
Yeah, I think we're very lucky that already from the start we brought on, mostly at least, investors that have almost an evergreen approach and have continued funds, significant continued funds to invest. And I think it's something to really look for. Most, I say, professional venture funds, and again, the range is huge, have, they make the initial investment, but then they'll keep in reserves, like I think the industry average is, again, the same amount for follow-on investments, which they then distribute across the portfolio companies. It doesn't mean you'll get that specifically, but they'll distribute that among their portfolio companies. And many other funds cannot invest from their future funds again, right? So they couldn't just raise another fund and then invest again. So even if they love you, often just due to how they raise the next round, they don't have that ability to reinvest into it. So you will then quickly tap out on those investors in terms of how much they can continue to invest. But luckily, we've had many investors who could continue to from the Series A through the Series C and still can continue to invest now. And that's really helpful because what they typically do is they invest at pro rata. So what that means is, that's kind of the standard, is like that's their share of the company. So if, let's say, they own 10% of the company from the Series A, they'll continue to take 10% of the next round, and you have to raise 10% less. So that just increases your ability to fundraise, and that signaling value, as you suggested as well, is really important too, that they continue to do so. So it can work against you as well.
Fair enough. Yeah. And next to this signaling value that you mentioned, there's also, we heard before, the storyline, right? Like what milestones you want to achieve, etc. What is a good storyline that really attracts investor in that sense? What are some good milestones to share in that sense? Is it users? Is it revenue? What is it that really appeals?
Yeah, I think the general evolution from founding, seed, Series A, B, C, D, et cetera, it's just as the company matures, it evolves from kind of the dream, the idea, and the founding team, which is really what it's about in the initial stages, to more and more financial metrics and more proof points around product market fit, but also your customers. You'll have a lot more customers at a Series B or Series C, which people will just expect to see a certain repetition in those. You won't be able to raise a Series B or C on one customer typically. You'll need to have a large, scalable market proof, and you'll be looking more and more of those aspects. And I think one of the most important aspects that we learned over, I guess in particular for the Series C, is just how important, for instance, recurringness of your revenues and the recurringness of the business base really becomes over time. Initially, that's not so important. It's become more important over time as well. But I think that's really on the basis where people can see, like, yes, this from the numbers and from the number of customers out there that you can still address, this can become a huge business. And that's what it ever more becomes about.
Maybe I can add there, Kai, what I saw, and I thought that was a very interesting LinkedIn post. There was someone, a VC, that said, typically the further on in the investments round you are, the further back in the deck the team slide goes. You basically, in the beginning, the team slide is very prominent if you're a bit ballsy about what you can do as a team, and then it starts going back. And the other way around, the further on you are with investment rounds, the more in the front of the deck you will have all the financials popping up, right? Because as Kai said, this is starting to become more measurable, more quantifiable, and if you're doing well, more of a success factor that you can sell to investors as well, right? So I found that very interesting to see how this moves throughout the deck usually.
It also has to do with exit, right? I mean, as you go down the alphabet of your fundraisers, you also move, and you're VC funded, right? Who will want an exit at some point. The financial metrics will be front and center. If you want to do an IPO, your team is much less of an argument than the financial performance of the firm, which will be analyzed through and through by analysts all around the world, right? So, indeed, I think the closer you come to an exit, especially if it's a public market exit, I think the whole thing gets quite unromantic compared to earlier rounds, where you're also selling, a future and to a certain extent buying into the potential of a market.
That will mean way more work for you, Frederick, as CFO, to get all these numbers right and focus on the right ones to fine tune in that sense. I have a follow-up question for Kai as well. Regarding the investors, when you change the investors, of course, you still have your existing ones, but there are also new ones coming aboard. How do you approach them? What is sort of a good way to approach investors for Series A or Series B rounds? Because they are usually, at least from my perspective, more professional. They're bigger firms than what you did in the past. So they probably also need a different approach than the investors you worked with before.
Yeah, I mean, but I think that naturally evolves as well. So through the series, if you gain professional investors already in the Series A, they'll introduce you to the B. And as you go through those stages as well, there's just less and less companies that are still in that space, and less companies that also those firms that you mentioned will be looking at. So as you progress, it's much less hard to get the first meeting. I would put ever less emphasis on that. You got a meeting as you progress through those letters, and it's ever more about, did you have a really good conversation? Did you really connect well with them? Did they pass you on to the really decision makers in the fund quickly? And did they react fast to it? Are they excited about the deal? All those points become more and more important. Further down, those metrics you look at more further down the funnel, if you wish, the fundraising funnel, and ever less about the introduction. So it's relatively simple to talk with all the funds after at least.
If I understand you correctly, it's not so much about just doing a cold email or a cold outreach. It's really your existing investors that give you the introduction, and then you take it from there. So it's sort of also really important which investors you have on board who can make and facilitate these introductions.
So yes, your existing investors can be a very key source, but I mean, warm introductions generally is how the market works still. Yeah. But you can get those from other founders. You can get them from funds who actually didn't invest in you but still kind of liked you. So there's many sources beyond that if you don't feel, or your personal investors at that moment don't have the reach to reach everyone you want to. So there is still kind of that element of hustling, but I guess it becomes less and less because you're more and more interesting as well. You've already reached a certain stage. They're more interested in talking to you as well because they'll be able to learn from you. So there's much more in it from them in that conversation. Versus if you're just like somebody with a dream and no proof points and a 1 in 100 chance of making it in the earlier seed stages, right? So
I love that. Frederick, we mentioned the 20% roughly that you give away as equity per round. Kai mentioned that, but still the valuation is an important point of every funding round that you do. So is it just whatever money you want to raise multiplied by 5 as a rough valuation calculation, or how do you do it from a CFO perspective? Because you probably also want to go higher than that if possible, I imagine.
Well, so in general, yes, coming from a dilution perspective is for sure not wrong. In the early stages, especially, it's not really going to be multiple or discounted cash flow or whatnot. It's very kind of financial model driven. So the dilution perspective, I think, is a reasonable one to get you in the ballpark. And as Kai also completely rightfully said, your target ticket size that you want to raise is for sure. That's also a pointer in how the valuation will be set. I would say 20% is pretty good. I would say somewhere between 20% and 33%. Dilution, but really then ultimately depends on the dynamic of the round. So, at the end of the day, it's the market that gives you a valuation. You can have a really sophisticated discounted cash flow model. No one really cares. Ultimately, you have your first term sheet, and if you only have one, then your leeway will be limited. If you have multiple term sheets, that's when kind of deal making starts, and also optimizing on valuation, but also other key terms, which in my opinion are often overlooked. So look, if you have a super high valuation, but you have a 2x or 3x liquidation preference, so basically implying that investors first get 2x or 3x their money back before common shareholders get that, then you're piling up, a very high commitment from your exit valuation towards new investors, and that renders the valuation much less attractive, right? So I would, in tendency, really look at the whole, let's say, the plethora of terms, valuation being one of them, to assess, which investors offer the most attractive deal, and then ultimately, it's also not always just valuation driven. There are cases where you might say no to a bit of a higher valuation because you truly believe that a certain investor can add much more value, even at a bit of a lower valuation or other more attractive terms, etc. So indeed, valuation is an art, and it has then to do with the momentum that you can create in the round.
Kai, I want to bring that back to you real quick for 2 follow-up questions, basically. The first one is, there's also value coming from the investors. I just recently talked to a scale-up entrepreneur. He was not particularly happy about the investors. He just said, look, in the end, they just give you money. They always promise you a lot of stuff, but actually what they really give you is money. Don't expect anything else. How is your experience there? Do they really help you beyond the money at that growth stage? Or is it just a bit overhyped and, you just get the money, but really not that much value beyond the pure financials?
Yeah, Kai, remember this is being recorded.
Yeah, I can honestly answer there. No, so there certainly is much more value in good investors than just the money. And I think you can optimize for better terms if you just want the money and you think you can do with that. But then you often will have investors on board who aren't a great fit, and it is very much a partnership. You likely will need more money in the future. At least most startups do. They also have control rights, right? So it's not as if they get something that with that equity comes control rights and a lot of influence around where the future of the company goes. So it's a long-term partnership you embark into, and you do have to think deeply about that. I would say in terms of stack ranking that, also those things, I think like the money is a very important factor they bring, and I would probably put that somewhere at the top. That's why you bring them on board. But then the next thing is the partner that they would send to your board is a very important person. It's the continued connection to that fund. It's the continued connection with also the value add that they can have and all their expertise that they can have. It's the person who's on the board who's going to work closely with you, who can really coach you and can educate you a lot of things. I mean, I think from our perspective, what they did immensely was just help us think about the next round and the next fundraising part, which is what they're much more professional about than we ever were. So they definitely have value add. And then the next part, and that person is really important as well, if you have a great connection with that person. So, I said you'll likely be connected to that person for many years to come. And then finally, a lot of funds have these additional structured resources around it for, a partner for people processes, or a partner for like marketing aspects and things like that. And I find those immensely valuable too. It's just a kind of a high quality, advisory network, and you can get that elsewhere if you find it. But I think if they have them in-house, it does often just connect it together very well, and it certainly has value.
So I get it. It's more than just the money. That's what you're saying. Perfect. The second question I have for you is, you mentioned before this sort of momentum to develop that, you develop a hot round. Suddenly you have the first term sheet, and then everyone wants in. And at the end, ideally, you as a company, you as a founder, you're able to choose how much money you want to get and from whom you want to get that. How do you develop that momentum? I know this is the billion-dollar question probably when doing fundraising, but what can you do to positively influence this positive momentum?
You want to get as many people interested and progressed along, into their diligence, I guess, the pre-term sheet diligence, at the same time, right? That's really where I would say the magic lies, right? So you have to have a great story. You have to have enough connections. You have to get enough kind of like engaged into that funnel that they also progress, because many will drop out for all sorts of different reasons that also you can't control, even if your story is fantastic. So you do have to kind of see it as, I guess, a process of which you find the right things together, and the ones who want to go for you, the ones that you want to go for. And then hopefully in the end, you have enough in that funnel that when one gives you a term sheet, that then typically creates that dynamic where more give you a term sheet. In my view, it's really a lot about the numbers, right? So putting enough at the top of the funnel, getting enough through, making sure that the story is fantastic enough that enough of them engage with that. So, and that's aside from the fact that you have to build a fantastic business as well to be able to qualify in that process in the first case.
Of course. But if I understand that correctly, it also means that ideally you have a pretty short time when you reach out to the people, so that momentum can actually develop. If you spread out the meetings over multiple months, it's probably very difficult that you have multiple interested party at the same time. Is that a fair statement?
So I think a fundraise typically takes multiple months, but yes, you want to go at it in a concentrated way. So you do want, compressing that to as many meetings as possible in a short period of time is certainly valuable. But a lot of funds take a lot of time, right? I think like there were the peak times, and there still are like areas of the industry like pure play AI players where I think those deals can still happen in the matter of, I guess, weeks. But in the most cases, they take their time, and then it's often more like 6 months where you get to know each other. Sometimes it's even much more than that. So it's not about weeks, I guess. It certainly is months where you have to concentrate that process into it.
Got it.
I don't know if you also see it like that, but I feel like if you're not the hottest company in town, deal cycles have become much longer. At least that's what I see from the investments where I am. as an investor. That, you know, like 4 or 5 years ago when the market was really hot, it was relatively quick that you had interest together, or you knew this is not going to work. Now everything is a bit more prolonged. Everything that took 2, 3, 4 weeks before now takes maybe 8 weeks. Everything's a bit slower. As Kai said, like they like to take their time because they can. Like, I feel there's not as high competition anymore as there used to be a couple of years back on the average deal. Obviously not on the top deals. I think there nothing really has changed. I don't know if you also see that or if you disagree.
So maybe, yeah, I agree to a certain perspective with regards to the risk, right? And risk is often also mitigated by having a strong syndicate. So and then that syndication process takes some time. So you have maybe, you know, 2 or 3 good investors, and you'll need to think about also the way you run the process on how do you potentially start merging those together to create the confidence for the round then to come together. And that syndication process, that takes some time. If you have massive FOMO, then you can just basically tell the people, look, you either shoot us a term sheet in 2 weeks or we won't engage with you, right? I'm not sure that's healthy, by the way. But I think that syndication process also, from a perspective of you know, risk sharing, have different perspectives on the deal, have different due diligence, let's say focal areas where that different investors, also partially different types of investors, bring in CVCs, typical VCs. That creates kind of a bouquet of different, let's say, profiles around the table that reinforce the confidence in the deal. So that takes some time. That doesn't necessarily mean that you're losing momentum if you do it right. No.
And I think, like, just maybe picking up on a point that you also made, it's like, it's good it takes time, right? I mean, it's a partnership that's going to likely last for many years, right? And, you know, it's good to get to know somebody a little bit better in that process rather than just jumping into it, right? It is both ways, right? They have to like you, you have to like them, you have to work with them for a long period of time, you have to believe in their values, there needs to be a certain rapport that builds trust, and that takes time too.
Are you guys also doing, Kai and Frederick, or the two of you also doing background checks on the, you know, like background checks, let's say reference calls on the investors? Do you know, like, as you said, you want to get to know the person, but you also ask other startups in their portfolio how the collaboration has been with them, how they experienced them, these sort of things? Or is that something that you did maybe only in the early stages and then you stopped? I mean, for us, that was always the best practice to do it, but I'm not sure how other founders do that.
Yeah, absolutely. So would definitely also do that. I think what also changes then over the later stages is that you have personal relationships also between existing investors and new investors that are able to create, you know, or to give you some three-dimensionality around, you know, the fund and the people behind it. So that definitely, having someone that comes with a very high praise from your existing investors whom you respect and who know you well and the company well, I think that also goes a long way.
You want to add something, Kai, or all set?
Yeah, I think the more you can know about them, the more you can get to know them before you go for the deal, the better.
Fair. And Laurent, in that sense, it's a due diligence on both sides, right? The investors on your company, but also you on the investor. What are some red flags that you as a founder should really look at or avoid from the investor side?
That's very difficult to just, you know, pack it into a small statement, in the sense that there's so many degrees to this, and it depends on where you are in the market, how much choice you even have. I mean, obviously, hopefully you can choose between some investors, but for the majority of startups, that will never be the reality. It's a choice between, do we take them or do we try to bootstrap, or, you know, do we find another way to move on? You don't always have that choice, but I do think, and we touched on that before, Frederick and Kai did, you know, other terms than just evaluation. If there's crazy liquidation preferences or voting rights that are being disturbed in the wrong direction, or veto rights, and these sort of things that you start feeling like this is not going in the direction that I want this as a partnership. I think those are very, very important red flags. And then second of all, that's the point that I tried to touch a little bit on before. If you feel from reference calls, people are not really telling you the truth about that investor. I've seen that in, unfortunately, one of my investments that went bankrupt last year, where we got a very nice investor in, and the reference calls, the founder, the CEO said, I'm not so convinced this is a good investor for us anymore. Like there's something off. We did it anyway. And it ended up being a complete catastrophe, having someone in your board that is actively working against the management. And that can completely destroy a company, right? So you have to be very careful with who you chose, as Kai said. And I think it really comes down to getting as much info about the person as you can, having a good feeling about that, and making sure that the terms you have are not so restrictive or potentially destructive in the future that you don't feel comfortable with it anymore.
Yeah, it sounds that when your gut feeling tells you there's something off, or there might be something off, there probably is, or at least you should look closer to really find out. Kai, I wonder, from your experience and your strategic decisions, you now have investors on board, obviously, but was it ever a serious consideration for you and your team to say, no, we don't want to get investors on board?
So we always started off with huge ambitions, so that went way above our heads. And from that, certainly wouldn't be the Viva that we've built if we had not had investors on board. So it would have been very hard, and it would have taken much longer, and would have been a very different company. So probably no.
Yeah, fair. It also very much depends on your ambitions, your business model, etc., and also the investment needed to push it to where you want to take it. Frederick, when we talk about investors on board, of course, you get the money and you give away equity, but especially for you as a CFO, imagine there are also additional costs in terms of communication, overhead, etc., despite all the benefits that you get from investors. So what are prices beyond the equity that you pay when getting investors on board?
So one obvious one that we, however, already talked about a bit is governance, right? It's not only up to you how you run the company, but you have other interests on board. What I find typically is that institutional financial investors are quite predictable because they ultimately are interested in financial returns. So they're in a sense, predictable, that they want to enable. It's a bit of a trade-off, short-term, long-term, that you need to kind of actively manage, but it's quite predictable in that way. I think if you work with private investors, primarily, and not just as a complement to a round, which we didn't do, and then there are also some additional aspects of maybe to a certain extent, not knowing exactly what the dynamic is that you're potentially playing against. There can be very many different reasons why also private investors choose not to double down or do something else or lose interest or whatnot. So for me, predictability is quite important. Obviously, then it's the price, the overhead can be on reporting, as you mentioned, but it also, I think, ultimately will shape the way you build your company. I truly believe that if you have financially driven investors on board, you tend to take the right decisions to make the company successful. I truly believe that. However, that's not a fit for all kinds of companies and all kinds of founders, personalities as well, right? Yeah. So as I mentioned earlier, I think you need to be very aware of, as a company, when you start off, like what does this company need to be successful in the long term? What kind of organization do we need to build? And what kind of people do we take on board this journey? Because if there's a mismatch between your ambition or the potential ultimately, or the personalities, then the costs of bringing in investors can be quite high and disruptive.
I also like what you said about getting, the reporting. I also see that a bit of getting more professional, right? When we were bootstrapped with the last company, we just didn't have anything in place because there was enough money, a very luxurious situation to be in. But at the same time, I felt that we probably didn't focus too much or enough on the operational excellence. And I guess the investors also train you to get a bit more professional in that sense. You also mentioned incentives, Frederick. And I wonder from you, Kai, how do you make sure that in the long run, the investors that you take on board and you as founders are incentivized to reach the same thing, the same milestones? Because I can imagine at one point, maybe you have an offer on the table that would be life-changing for you as founders because you would make a lot of money or get amazing shares in a new deal. But for the investors that came in at the high valuation, it's maybe just okay or not even a good deal. And then you have very different incentives how you would treat such a thing. How do you make sure that you and your investors are aligned for the long run and don't have a misalignment in that sense?
Yeah, I mean, I think those are the moments where, I mean, it's a hard moment that you describe, right? If there's clearly very, very different incentives on the table there, where it just financially goes far apart, and that is really hard, and probably will then come down to voting rights and power in that structure. But I think what one does have quite a bit of influence in that moment also as the founder. If they hear that the team wants to go for that deal, they most of the time will not vote against it unless it's punitive for them, right? I think that's kind of their probably hard side of their perspective, is that they have to believe in that team that wants to take it the full mile and not sell quickly. So I think in those cases, it can come down to exactly what the control rights are. I think overall, the most important thing to do across that thing is to build great trust by being honest, upfront, transparent. And that's how you keep things together the best way. But if it's a hard financial decision between financial investors, I think you'll come down to the voting rights likely in the end. So look
Fair
out
enough.
for them.
So protect them if you can, if you have the leverage to do so.
Yes,
but let's say
in larger structures, as you look at that, I mean, there are then investors who then much more earlier stage who invested then much before as well. So that's I guess the risk of the latest investor, right? That they are investing at that highest valuation point that the company had so far, and I think that it's also rare that you would try to sell at that point, because then you've also created the plan and you want to grow the company and you've raised more money, so you've diluted as well. So there's really no one who benefits from selling at that moment. Obviously, if the offer that comes along, maybe it's a little bit different, but
fair. Laurent, let's say everything worked out. We closed the round. We often see that on LinkedIn, to close the loop if you need LinkedIn status. There's a lot of celebrations on LinkedIn, especially about closed funding rounds. How, and even if we should celebrate such rounds, what do you recommend? Is it a moment to celebrate as a team, to say, hey, amazing, we just got a lot of money in the bank to execute our plan? Or is it more like, the game is on, the pressure is on, now we need to deliver? How do you see that?
I think it's absolutely imperative that you go and have a good celebration around this. Not a super expensive, crazy celebration, because that's not the point, right? You don't want to go and say, now we have money, let's throw it out the window for a party. But you should go and really celebrate that as a team, because the startup journey is hard. I mean, as Kai said, you're banging your head against the wall 1,000 times. Everyone in the team that is pushing, you need to have those success moments, those winning moments that you go and celebrate. And then at the same time, you need to make it clear the very next day, okay, now head down, back to doing what we're doing, because it was just another financing round. It's not more than that. We're not even close to the goal that we want to be, or as Jeff Bezos would say, it's still day one. So yeah, you have to be a bit schizophrenic about that, go and celebrate it really passionately, and then the next day go in and say, back to work. We got
from
goals
the party to the office.
Yeah, or that, yeah. Maybe dangerous, but yeah.
Frederick, when you then have the investors on board, of course, you also have the reporting and the regular exchanges. So I wonder, after closing a Series A or B round, how does that collaboration look like with the investors? Like, how often do you send out the reporting? How often do you meet? What is sort of the best practice to then also collaborate and work with your investors?
Yeah, that's quite an important part, because ultimately, I believe you want to take your investors on the journey, right? You don't want to create a detach between, maybe what you sold them in the fundraise, and then just kind of lock them away and come back whenever you need money again, or you need something from them. So I think, especially building that trust is extremely powerful when stuff doesn't go as planned, and you don't have to, on the one hand, start a relationship from scratch, or surprise investors. Investors don't like surprises. They like being on the journey, understanding what decisions you're taking, what the outcomes of those decisions are, and then maybe the decision was wrong, and then you need to recalibrate. But having them on that journey versus it being a black box, I think that's important, especially for your larger, let's say, lead investors that you had within the specific rounds. So on the one hand, then, what is too little information? Too little would be that no one really knows what's going on, especially the people who should know, who then also have that, signaling effect on the other existing investors. So, if your lead from the last round doesn't participate in your next round, that's a pretty dark orange flag for all the other investors on your cap table. So I think that is important. That's too little if that's not the case. Too much, I think, is something that especially has to do with your efficiency. It can really eat into your efficiency. If every month you have to create 7 different reports for your different investors, and then every investor has a quarterly ESG report that you need to fill in as well, and XYZ, then it gets quite cumbersome. So trying to also in the agreements, that's a shareholders agreement topic, tailor the information right and streamline the information rights and make that very clear, so that you don't have just a mix and match and a wish list from every investor joining the round that you need to deal with.
Really good recommendation. I love that. And Kai, after the funding round is usually before the next funding round. When you close it, you can finally go back and execute the plan, work on your business. But at what point do you have to start fundraising again? Because I assume it just never really stops.
Yeah, I mean, I think different people take different approaches to that. I would certainly hope not. Right? I think it's very good to, I guess, stage gate those things. And I would certainly hope you don't have to immediately go into fundraising after the last round, and you can actually execute and get to the next milestones very well. And actually, hopefully, you don't need another round, right? I mean, that is always kind of the best outcome if you reach a fantastic outcome with as little money as possible. So hopefully not would be my answer.
I like that perspective. So to wrap up the conversation today, I would also like to ask all of you 2 personal rapid fire questions where you have to answer ideally in 1 sentence. Let's start with Laurent. What's the most underrated skill a founder should or could have?
Probably empathy. Super important, not really talked about too much. If you're too much into your dude masculinity, it's maybe even something that people see as a weakness, but I think it's the strongest thing that a founder should have.
Nice. Frederick, when it comes to financials, speed or precision, which one is more important to get the funding round closed?
Well, ultimately speed. Once you have momentum, you run like hell and close the round.
Got it. And Kai, for you, what's a go-to question for you to test if an investor is genuinely interested in your company?
Yeah, I think questions and answers are usually weak. I would just look for like the speed they take to get back and whether the real decision makers are then around the table or not.
Amazing. Laurent, who's one entrepreneur that you would love to have dinner with?
I can tell 10 of them, but let's say, boring one would be probably Bill Gates, still one of the greatest guys on earth.
Fair enough. And Frederick, what's one financial metric that you never compromise on?
Well, as a cash burning company, it has to be burn, because that informs you how much time you have to reach the next inflection point.
I love that. Kai, the last question for you today. If you could go back to the start of your Series A, what's one thing that you would do differently?
I probably wouldn't change anything. I'm happy with what we got to. I think we did a good job for where we were at the time. So I wouldn't change it.
Fair enough. Kai, Frederick, Laurent, thank you so much for being here today. It was a lot of fun, very insightful, and I really appreciate you making the time to have this discussion today. All the best. Happy Tuesday, and thank you for being here with us.
Thank you very much.
Thanks for having us.
Thanks.
Bye.